Welcome to The Investor, a podcast where I, Joel Palafinkel, your host, dives deep into the minds of the world's most influential institutional investors. In each episode, we sit down with an investor to hear about their journeys and how global markets are driving capital allocation. So join us on this journey as we explore these insights. All right, so it looks like we're live here with a new friend of mine, Jason Torres. Got to get to know him a little deeper in person at our holiday party. We're both New Yorkers, so honored to get him on the podcast and learn what he's building. So for the audience, Jason Torres is the managing partner of Sana Capital. They're a healthcare private equity firm, and they invest in overlooked founders engaged in information technology and service sectors. And just really excited to learn about your thesis and how it cascades across various industries and how you built Sana Capital. So I want to unpack all of that. We can talk about just kind of what we're seeing in the industry and the market. But before we do any of that, Jason, welcome to the show. Thank you for making time for me and the community, and excited to just dive deep on who you are, your education, your background. So again, thank you for coming. And maybe we can start with that. Maybe you can kick off with, what did you study? How did you break into venture and private equity, which is pretty opaque industry? And then just kind of go through your, all the turns and transitions into getting to where you are now.
Yeah. No, first off, thanks. I appreciate you hosting this, and that was a great holiday party. And so it was great to, see you and then, meet all the folks there. So I appreciate that.
Yeah,
but yeah, I'll just jump right in. I'm first generation. My family's from from Puerto Rico, a place called Vieques, which is a tiny little island off the eastern part. I'm first born and raised here. Family was born there, raised here. But mom was a social worker and in the city in the 80s, dealt with vulnerable populations, a lot of substance abuse cases, a lot of domestic violence cases. So challenging, difficult populations that typically get ignored and overlooked. And so that's a common theme and thread. So one, supporting and helping those that need help, and then the most vulnerable. And but my career has been at the intersection of finance and healthcare. Engineering undergrad, went to RPI, big engineering school, upstate New York. And that's how I got onto Wall Street. Had an internship at Salomon Brothers way back when that existed. And that's how I got on. They were looking for quantitative talent. From there, I moved over to Deutsche Bank. I was trading on their prop desk there, covered healthcare, TMT companies, and really unpacking these complex offerings that they had. So these CDOs and CLOs. And that's where I learned just pure fundamental analysis. Is this a good business? Is this a good company? How much to pay? And so that's where I got into that space. Went back to business school, got into Stanford, and that's where I got the entrepreneurial bug. And so going, being in the Northeast, it's very different going out West. And so that's where I decided, well, let me try something entrepreneurial. They give you sort of, get the courage to do something different. So non-consensus and hopefully right. And so that's what I decided to do. I said, let me either be the entrepreneur or back the entrepreneur. And so I did a hybrid. I started investing my saved up bonus money into companies. And pretty early on, I had a couple companies go public in a very meaningful way. And that's how I got into the space. I had to kind of fumble my way around. I didn't grow up with CIOs around the table, and that's not how it was. And so, while Wall Street was effectively a few miles away, it might as well have been another, world. And so very, very fortunate in that I was able to get an opportunity, get into finance, learn some, I think, pretty core skills, and then getting into Stanford and really getting the entrepreneurial kind of spirit and making that part of my fabric. So coming out of Stanford,
Mhm.
started investing. Then I started to see all the other VCs in this space and what
Yeah.
they're doing. And it's a clique, it's a tight knit network, and it is
Yeah.
very opaque, like you said. And so,
I mean, when
um,
you came to my holiday party, there was probably at least 6, 7 people that you already knew. So most people know about each other, and it's to your point, it's a small community. Even New York, I mean, people think it's a big city. There's 10 million people here, but it's really a small town if you think about
totally,
it.
totally,
Yeah.
totally, yeah. And then so where how did I get to where I am today? Joined up with it was a growth equity venture firm. I was at Mansa Capital for about a decade. Helped get that going, raised capital, and invested all in the healthcare space.
Hmm.
And so that's how I got into this space. Performed really well, very similar to what I did as an angel. As an
Hmm.
angel, I had a couple companies go public in a really big way. So two big winners, a bunch in between, two, three, 4x, a loss on one. And then even at Mansa, I have a big winner in that portfolio,
Hmm.
bunch in between, loss on one. So very consistent, and continue to refine what it is that we're doing today, which
Hmm.
is taking a policy-driven approach, studying what comes out of Washington, D.C. and what comes out of certain states in terms of healthcare policy,
Yeah.
translating that to a business strategy, and then executing,
Hmm.
getting contracts. So a step after the traditional idea venture, more in
Hmm.
the all right, we're expanding, we're growing, we have something, it's kind of clunky, but it's sort of working. Market's adopting it in a real way. Dogs are
Hmm.
eating the dog food, as folks like to say. And so it's at that point that we'll look to get involved with the company, help them grow, get contracts.
Hmm. Well, there's a lot to unpack. I mean, I think starting out with your career, I think the community could benefit from just some of your learnings, getting that first job at Solomon, right? So, I mean, you're in New York, and then you got that first job at Salomon Brothers. What's some advice that you would give maybe some young college students to stand out in the interview? I mean, there's one job, even if you look on LinkedIn, right? There's like one role, and there's like 500 applicants. So, back in the day, just think back, what do you think helped you stand out to kind of land that first role to break into finance?
Yeah, it was for me. It was a program that really helped get me trained up in all of the
Hmm.
unspoken rules. Program called SEO,
Hmm.
and they are phenomenal, and they really get you coached up on just making sure that you perform, and they
Hmm.
give you the tools to do it. So, and in an engineering school, I'm not really taught I didn't grow up with all of the kind of the
Hmm.
finance trappings and have that around. And so, but they help get you educated and get you coached up to a level so that you can perform at your best so well that that the internship that you have is going to want two of you next
Hmm.
year. And so that's really what that's really sort of how and so I just take that throughout. You got to make
Yeah.
sure, got to perform, you got to hustle, be willing to outwork anybody. It's a little bit different than what I'm seeing today. It's not so much about quality of life, or you're in the very, very early days. You've got to
Hmm.
learn and perform and really make your bones. And
Yeah.
unless if you're not willing to do that, there's a bunch of other people behind you that are, and then maybe that's not
Hmm.
the right role for you. And so just you have to really want it. When I talk to folks when they come out and they want to get into this space, well, all right, if you want to differentiate yourself, because there's so few roles, it's really hard to break in. There's not a track. It's not like a massive
Yeah.
bank or a massive firm or a massive consulting firm where you have classes that get
Hmm.
hired. That's not how it is in this industry. So you've got to differentiate yourself by saying, all right, making the conversation relevant to who you're speaking with. So
Yeah.
finding a company that they would be interested in, finding a potential acquisition target that they would be interested in,
Yeah.
getting to know a founder, or maybe being the operating person, maybe being that finance CFO type of
Hmm.
person. That's how you get in, so that you're not talking about give me a job. You're talking about, hey, this is how This is how we work. This is what I think. This is what even if they don't agree with you, it doesn't matter. What
Yeah.
matters is that they get to see that you're actually doing the role, not
Hmm.
talking about it.
Yeah.
And that's the advice that I give folks.
Hmm.
And then folks that are still in school, you have to, your peers are going to become your network. And so not being the free rider in a group project is
Hmm.
important. So,
Yeah.
and you know exactly who those folks are.
Hmm.
Don't be that person,
Yeah.
and make sure that you're pulling your weight, because in 2, 5, 8 years, when you pick up the phone, you want them to, when you call them, you want them to pick up the phone, and
Yeah.
you don't want them to sort of look at it and say, what does this person want? You
Hmm.
want them to be excited about you calling them, because you've been someone who's produced, performed, when you didn't really have to at that level, that you've over delivered. And
Yeah.
so that starts now. That starts in the class.
Hmm.
That starts in the group projects. That doesn't start later. That is developed now.
Hmm. Yeah, I totally get. Have you ever heard of Inroads?
Oh yeah.
Yeah, yeah. So I was part of Inroads early in my career, and there's a few things that I learned that still stick with me, and thanks to them, I actually landed a couple internships at some big companies. But there's like a couple things that still stick in my mind. I mean, one of them is, never wear like a heavy cologne. These are things that you don't learn. Like they don't teach you this even in college. They're just kind of like emotional intelligence things. But like, it's still to this day sticks with me. Like if you have an important meeting, you never know. I mean, the person that's interviewing you might have had a bad experience with that cologne. Maybe their ex wore that cologne or perfume. So that stuck with me. Wearing a white shirt with just a dark tie, that's just very, very neutral. So it's kind of hard to have a bias versus kind of like a blue shirt with like a red tie. So, just little things like that in terms of just dressing, grooming. There wasn't anybody that really taught me those basics when I was starting out. So, just some of those things, always send a thank you email. So, I think there's just understanding the etiquette gets you halfway there. And then, there was one time where I got a really great career opportunity because I think I just went above and beyond and wrote like a memo or wrote some type of additional research, and I printed it out and gave it to them. So I think they were kind of left with that. So I think just doing things that maybe the typical candidate who is probably entitled, they went to Harvard or they went to Penn, expecting the role, they may not be as hungry and as creative as someone that has to be creative and hungry to kind of get that opportunity. So I think you alluded to a lot of that, like act like you're already in the role, bring up, 2 or 3 deals that maybe are relevant to their current portfolio. I think is definitely good advice. Um,
Yeah. 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 I mean,
mhm,
you're going to change the conversation from what can you do for me to what can I
mhm.
do for you, which
Yeah.
is that's the conversation that folks want to ultimately have.
Hmm.
And coming with a company that, yeah, I mean, stuff in the real estate space, having a few real estate opportunities and knowing the
Hmm.
founder or the owner, and
Yeah.
and say, hey, I'd love to make an introduction here. Now you're engaged, and
Hmm.
this is not a, what can, how can, great, I have to have, let me take this time and just see what I can give, the person a job. It's not like that. It's like, oh,
Hmm.
this is speaking directly to your, you know, ultimate net worth and your,
Hmm.
investment opportunity. So like that's relevant and that's
Yeah.
meaningful. And that's how folks will differentiate themselves, uh, and in this space, coming with a deal, demonstrating, or coming with sort of a founder and an opportunity that could be M&A work, or what have you.
Yeah, no, that's helpful. And then I want to double click a little more on the differences that you've experienced being being in the Northeast, going to the West Coast. I mean, and I'm going to tee it up. I'm assuming people in the Northeast are all about, working on Wall Street and, you get praise. I mean, this is back in 2008. I mean, people were praising people for working 90-hour work weeks. And then I think after the recession, everybody got burned out and people were like, look, we need to find some type of work-life balance. I want to, create some impact. And then the West Coast, I mean, I've never lived on the West Coast. I've been there several times. But I would say the West Coast, kind of to your point, is definitely probably a lot more laid back in terms of like pedigree and, what school you went to, or, what firm you're working for. And they're more about being builders. But is that kind of similar to what you experienced? And I'd love to learn a little more about like maybe the conversations and the peer groups that you had, and how they changed, and just kind of maybe the vibe that you felt, comparing both, communities and coasts.
It very much in the Northeast. I think
Hmm.
I agree with that characterization. It's work harder,
Hmm.
run faster, climb higher. The goal was to be a partner at a law firm, or to be a managing director running a desk at like Goldman, or running
Hmm.
the group of, pick a group, the tech group, and so it's that was sort of the goal. On the West Coast, at least Northern Cali,
Hmm.
that's like the worst thing you could do, because you give up your life for what is the, what are very attractive economics. Uh, so if you but your economics are effectively
Hmm.
capped on how well the market does, how
Yeah.
well your division does, how well your group does, and then how well you do within um, your your role.
Hmm.
And whereas if you do something entrepreneurial, if you crush it, there's no limit. And so if you're not that good, or things don't work out, well, okay, you're out of a job. If things don't work out and you're not that good at one of these top firms, you're out of a job. And so it's the
Yeah.
downside is not that different. Meanwhile, the upside is very different. And so for me, it took me going out to Northern Cali to learn that,
Hmm.
coming from the
Yeah.
Northeast.
Yeah. And I mean, famously, we've got Naval Ravikant that I guess talked about the four pathways for scale and leverage, right? I think the four was like capital, labor. Well, I mean, they say labor here. I think labor, probably stands for something else. I don't know what the C was, but it was capital, code, and then content. And then I forgot what the fourth one was. But I mean, the fourth one in the list that I pulled up here says labor. So it's probably a C word for labor, community probably, or something like that. But, it really makes sense, right? If you've got capital, you can just scale your revenue and just get more leads, get more people taking more calls, and essentially grow the business, even though you're not profitable. If you got code, you can do something that a human does, and do that 100 times, and resell that product. And then obviously the content, helps you get the message across to many people, multiple times, repeatably, all day, every day, right? Um, and I think that that's what you experienced with some of the exits that you had, as an angel. Talk to me a little bit about your angel experience. Kind of what frameworks you had, picking the companies. Obviously, we're not always right, but you did really well. So, what are some learnings that you learned as just being an angel and putting some of your own personal capital to work?
Yeah, really started to learn just about people. Coming from Wall Street, it's much more about balance sheets, income
Hmm.
statements, cash flow statements, and then the more you go, or the earlier you go, the more it is about people and
Hmm.
characteristics in people, which is very different. And that was sort of the big learning. So, for example, um, Athena Health, big IT success story, healthcare IT success story. Some really just top founders. You have Todd Park, you have Jonathan Bush. Got involved with them fairly early.
Hmm.
They started out effectively as a mobile midwifery type of company, which is a doc and a midwife in a van looking to improve birthing rates of women.
Hmm.
They had
Okay,
a
so
very
it's mobile. Is the community for people that just are not near a hospital, and they just kind of want, and they just prefer to do, the birth at home?
Not really a preference, more of a
Hmm.
sort of a more like a sentence almost, where
Okay.
a lot of so the U.S. has terrible, mortality rates for
Hmm.
Black women. African
Yeah.
American women in this country have, you might as well be in Mongolia and you'll have a better outcome than you will in the US, which is just
Hmm.
awful. And so the idea was, well, let's bring healthcare to the community.
Hmm.
And which was a terrible idea because it's just a bad business, certainly
Hmm.
not sustainable. And so here's a good lesson, like, that I'll talk to with founders. Thank God they made the pivot. And the pivot is recognizing that while that's a noble intent and a great thing to want to do, you don't get to do that until you fix the problem of who your
Hmm.
customer is. And what they realized is that they were awful and terrible at getting paid. And
Yeah.
so what they had to figure out was what's now known as revenue cycle, or basically fintech and healthcare payments,
Hmm.
getting doctors paid. And so once they figured that out, now the doctors and the midwives, they don't have to be um, insurance specialists after hours. They can
Hmm.
actually deliver care. And so
Yeah.
that was the big aha. And most founders won't make that pivot and won't make that intellectually honest decision like, wow, this really isn't what we need to solve. We need to actually solve this thing first.
Hmm.
And so they developed one of the leading early innovations in healthcare outside of hospitals for providers of getting doctors paid, revenue cycle management. And they were the
Yeah.
darling of the industry for about a decade, at least, or
Hmm.
more. And but all the lessons learned, ups and downs along the way. But that was so so that's one of the characteristics that we look for in founders now, is just the
Hmm.
ability to evolve. Do they have, EQ? Can they be self-reflective and intellectually honest about what it is that they're building?
Yeah.
Most founders will become enamored with their and tethered to their offering, to their delivery,
Hmm.
to their technology. It's like, oh, well, we
Yeah.
need to go have earlier hours or more hours or
Hmm.
weekends, or they would do basically more of what they're doing, slightly calibrated. That's what I see in most founders. But the
Yeah.
founders that actually bust through and break out, they just have to press pause. This is a company that was losing money at an accelerated rate. And
Hmm.
so, so they had to really, take an honest look back. So that's an example
Yeah.
of a company that ended up going really well, and lots and lots and lots of learnings along the way.
Hmm. Yeah, and sometimes you need your back up against a corner to be able to motivate you to pivot. Like you said, it's not a choice; it's a sentence, right? It's like, look, if I don't do something that's completely going to transform, the way that we're collecting money or the way that we're going to generate revenue, we're going to die in like X amount of time. So sometimes that pressure, puts a lot on us to make that change. I mean, and I think it's, like, I mean, I've seen, fund managers that have families, and just the pressure of having a family and knowing that you got to support your family, that's pushed people to kind of have a bigger mission to push the envelope beyond just kind of the normal path. A couple things that I think would be really interesting for the community is how you can take that angel track record, maybe build a synthetic track record, and use that to kind of, hopefully build some type of brand for yourself. Eventually, hopefully, a franchise to scale that into your fund one. So, any advice you have in terms of, early stage angels that are kind of maybe working professionals that are starting to do these deals? I always think it's helpful to track, your markups and track the progress, and kind of run your deal flow and your selection criteria, and then eventually your investment committee outputs as a track record. So like how much capital was put in, what's the what's the MOIC right now on paper. But like any advice that you have in terms of that first step, how do you get from the part-time discipline of kind of picking deals, maybe with a community or an angel group, and then eventually institutionalizing that and building trust and credibility with LPs to get to your fund one. And maybe if you got some stories on your journey, that'd be helpful too.
Yeah. Well, one, it takes time. And it takes time because if the goal is to ultimately get to institutional investors, pensions, endowments, foundations, that takes
Hmm.
it's speed of trust. And
Yeah.
there's they can invest potentially in you with a sort of a light, not well documented um, kind of track record, or they can invest in
Hmm.
folks that have been doing this for a long time and
Hmm.
that everything is really buttoned down. And so if that is the goal, then to start to develop the body of work early. And
Hmm.
so the more cash on cash, the better. And then the more institutional, when even if you're taking a small amount of capital from other folks, the more managing of other people's money, the better, even if it's small. The
Hmm.
when the early on, I wouldn't recommend going the consultant route. That's or going through and with consultants. They are not really known for being supportive and helpful and advocating for early managers.
Hmm.
That's not what their mandate is. And it's
You
no
mean for
offense.
capital? You talking about capital intro, like broker dealers?
Yeah,
Yeah. Yeah.
yeah. Their mandates are typically to have an asset allocation strategy and
Hmm.
find certain subsectors,
Yeah.
and that usually does not include early managers. So I
Hmm.
know folks get pretty frustrated going down that route, and that's what it is. They will be increasingly important the sort of larger and bigger that you get, but
Hmm.
early on, you got to put points on the board. This is you have to find good companies. You've got to invest in them, develop them, and then exit them, and you've got to
Hmm.
sort of demonstrate that it's repeatable. You can do it again and again, and then scalable, that you can do big amounts, that you
Hmm.
can, instead of putting 50K, 500K, 5 million, that you can do that again and again. And so that's sort of what you have to demonstrate. That's not a flick of a switch. That's not
Yeah.
an overnight. That takes time.
Yeah. No, I totally agree. What are some ways that you've seen have been effective to develop a community around you? So, you're focusing on a lot of growth equity and healthcare. So, what are some learnings that you've built to kind of get those people around you that have like-minded interests and may not even be LPs, but just people that you can co-invest with and compound over time with just great people to develop your peer group, especially if you're moving to a new city starting from scratch, right? I'm assuming when you went to San Francisco, you might have had some of that community from the MBA program, but you still had to develop your own peer group, and there's probably cliques. They're like, "Who's this New Yorker Jason coming in here?" We've already got our crew here.
Yeah.
So I think what would be advice that you'd give to just people that want to kind of develop that community?
Yeah. I care a great deal about equity.
Hmm.
Equity in terms of access to capital, equity in terms of access to healthcare. And so for me, I look at and I look for people that care about those same things or similar.
Hmm.
And then I look to be supportive and helpful. So intros to capital, I have LPs, got some good institutions now in my firm. I've since spun out. I got anchored up last year. That was a tough environment. We got a bank, an endowment, a foundation, and then most recently one of the largest pharma companies on the globe has now backed me,
Hmm.
and that wasn't easy. It wasn't a flick of a switch. They had to see and be aligned. And so what I'm spending most of my time now is looking um, for alignment around health equity, around access, outcomes, cost. That's our mission. And so that's what we're looking for. So a lot of payers, a lot of providers, health equity foundations that care about giving access to healthcare, because that's what I'm passionate about. That's what I get up at 5:15
Hmm.
every day. That's my purpose. And so just
Hmm.
aligning and spending as much time with people that share or have similar purpose.
Can you unpack access, outcomes, and cost, and maybe some of the things that you measure to see what moves the needle in those three areas?
Moves the needle in terms of
So access. So, are we looking at, just providing access globally, like, having just more accessible access to affordable healthcare, and then when it comes to outcomes, what are some things that you look for? Is it just providing the treatment? And then I guess the cost, is it more just like cost savings? Or just providing more for, and some of them may flow into each other, I'm assuming too, right?
yeah.
Access, you could provide access through having lower costs as well. But I thought it may be helpful for the audience to kind of unpack that thesis a little bit.
The U.S. has some of the best healthcare on the globe,
Mm-hmm.
but it's not accessible to all,
Yeah.
and so that's problematic.
Mm-hmm.
That's a gap there that we can fix. On the outcomes, we have the best healthcare, but we have some of the poorest outcomes of any, first world country, and so that's just sickening. And
Mm-hmm.
then really around cost, it's really around the friction that it shouldn't cost this much. The system is chaos, and the
Mm-hmm.
system is uh, locked in conflict, and so which creates friction, which creates costs,
Yeah.
and that's what we look to on the margin, because it's very difficult to have systemic change. No one would ever uh, you know draft and build the healthcare system that we have today from
Mm-hmm.
scratch. It has
Yeah.
evolved over time. It's like this patchwork, and so really where the innovations are sort of on the margin, and the innovations and the disruptions and the real benefit comes by fixing it sort of on the margins, or
Mm-hmm.
typically around those areas. We haven't talked
Yeah.
about pharma. Pharma is separate. I mean, I'm not a scientist, I'm not a researcher, so
Mm-hmm.
we don't invest in the molecule, uh, but everything after that, once it's looking to be commercialized and get onto the formulary and get a CPT code and expansion, then we'll look
Mm-hmm.
to invest. But prior to that, so really what I'm talking about is IT services, the the bulk of healthcare.
Yeah. No, that's helpful. And then I'd love to learn a little more about your sweet spot, your entry point, what you consider, I guess, growth equity, maybe early, private equity, kind of what's the area for founders to make sure they're a good fit in terms of your investment thesis? Is there a certain revenue metric that you look for? Obviously a certain stage that they're entering. The issue is sometimes the stages could be interchangeable, right? Like for someone like a series A could be essentially a seed plus, and it's almost, the same check size. So how do you look at stages, and then what's kind of a good, in your stage, what's kind of a revenue, um, you know, ARR that you're kind of looking at that's sufficient to manage your risk. Um, and then let's talk about that. And then I'd love to know kind of like just advice you have for people to kind of build their discipline as an investor. But let's talk about that, and then also how people can collaborate with you, maybe upstream or downstream.
Yeah. Companies that we look for, they'll be serving one or more of those kind of verticals around access,
Hmm.
outcomes, costs. They'll have some real revenues. So for
Hmm.
us, it's not a specific ARR, specific revenue, because some industries are different. A contract will
Yeah.
be $4 or $5 million, one contract, or it can be a few hundred K. It just depends.
Hmm.
But we look for a contract and beyond pilot. So post pilot,
Yeah.
real being market rate,
Hmm.
so that so that we know that we'll have a customer. That's for us
Hmm.
kind of the delineation. At that point, it's not perfected. It doesn't have to be optimized yet. We don't have to be
Yeah.
EBITDA positive. We should have some sort of line of sight, but like, okay, now the stuff is working.
Hmm.
The offering is working. It's being paid. The customer had an opportunity to go someplace else. They re-upped. They didn't. They came back and now
Yeah.
you have the market contract. So you've proved out the pilot. And so like that's what we look for. Because at that point we can say, all right, it's working.
Mm-hmm.
We can now call up our LPs, our friends, our colleagues, our network, and help you pour gasoline into that engine.
Yeah.
While perfecting it, we're getting it calibrated. But all right, now this is working.
Mm-hmm.
So
Yeah,
that's
going
sort of
back to Naval's, I was going to say, going back to Naval's point, one of his C's, or whatever the word was, labor, right? So the limitation of just having that one contract, maybe because there's just one sales rep, right? So if you had the additional capital from a capital provider like yourself, that'll just give them the bandwidth to have like maybe two more sales reps, hire high quality seasoned people that have the network, and that could generate probably a 2 to 3x in their contract based revenue. But it's just the limitation for them is probably just, especially in these enterprise B2B long life cycle industries, there's a lead time to get from like, pitch to pay. So I think, would you agree that sometimes the labor would help them just accelerate, and like the labor contributed to additional capital to hire them?
it can.
Mm-hmm.
It I think some, depending on the subsector, there's some cyclicality, there's some
Yeah.
seasonality
Mm-hmm.
in when you're selling. It may be that if you're trying to sell in January and February, that's already been contracted last year,
Yeah.
and you may have to sort of wait till the next season of open enrollment, for example,
Mm-hmm.
right? And so
Yeah.
yes, but mate with a little asterisk on
Mm-hmm.
perhaps when. So that's so yes, small s.
Yeah. So it sounds like there's also capital needed to just carry the burn rate up until, for example, like you said, like to just carry you up until open enrollment season, so they can take advantage of that perfect timing to be able to build in that, or just grow that new contract, the revenue.
Yeah, yeah.
Yeah. And then another question I had, and I know we got about 15 minutes left, but what's some advice that you would give to early investors, maybe people that are just joining new firms or emerging managers, in terms of the discipline of effectively sourcing and screening and then diligencing these companies to investment committee?
Yeah, yeah. Have a thesis. So
Mm-hmm.
for us, and have develop your own conviction. I
Yeah.
we'll lead,
Mm-hmm.
we'll follow, but after developing our own conviction. But we
Yeah.
don't need others to to be in or not for us to develop our conviction. We
Yep.
develop it independently, and we have a thesis and we have a plan, and we can see a path forward
Mm-hmm.
on growth.
Yeah.
And so for us, I would say for folks that are coming up, regardless of whether it's healthcare or not, you have to have an edge. And for us, our edge or perspective and lens that we look through is policy. We
Mm-hmm.
study what comes out of Washington, D.C., what comes out of certain states in terms of Medicaid. We translate that to a business strategy, and then we help get contracts. It's very simple. Not that simple is easy, but that's what we do, and that's how we do. And we've gotten quite good at that,
Mm-hmm.
to the point that founders now seek us out because we're very good at, one, we're known for being good partners, and then two, we help get them into the government space if they're commercial facing.
Mm-hmm.
The reason that's important, and founders and the market continues to recognize that, is that you get a premium multiple on your exit if you
Mm-hmm.
can demonstrate sales and execution of both commercial and government contracts. You're
Yeah.
effectively doubling your addressable market depending on what sector you're in, and you'll get a 2 to 3.5x more on your exit.
Mm-hmm.
That's the hardest thing to do in investing, is multiple expansion.
Yeah.
and And so we'll go hard in the paint for our founders to help get them into that space by positioning them for an RFP,
Mm-hmm.
getting them introduced to government affairs folks, lobbyists to get out in front of an RFP as it's being drafted. It's very much a ground game. It's a partnership, and
Mm-hmm.
in that we're looking uh, to get a differentiated type of business and customer. And
Mm-hmm.
so it's not overnight. It takes time. It takes investment, and it takes relationships. But that has a big reward at the end of that, and
Mm-hmm.
that reward is an enhanced exit multiple. So for folks that are coming up, figure out your thing. So for us, it's policy, government. That's
Mm-hmm.
we know that through and through, and we help companies grow and expand their businesses. Figure out your thing.
Yeah. Yeah. I think two things that I can extract from that, if I may. I think, that's probably something that maybe some young investors may struggle with in terms of conviction. Obviously they're new to the firm or they're just starting out. So, there's obviously, strong personalities at the investment committee table that are very opinionated. So to have the confidence and the courage to have a differing opinion, even if there's a partner at the table, as long as you're contrarian and right, hopefully back it with some data. I think that's definitely an important skill to have. And then I think to your point, the edge, the other thing I'll add to that is, a lot of these great founders have a lot of capital provider opportunities. They have a lot of great fund managers to choose from. So the fact that you have these connections and you have the policy, best practices, that definitely helps you. And I would say, like, whoever the fund managers are, just thinking about like what they could offer. I mean, there's a fund out here in Jersey that will actually build like they actually have a dedicated sales manager that will actually help the companies generate more sales. They'll build their sales practice out, maybe even help them recruit more enterprise salespeople. So that's true value, right? Because you're actually helping them generate more value, and they have a vested interest, right? If they can get their customers to get more revenue, then hopefully that'll get them to the next funding round. So I totally agree with that. What are some of the biggest learnings that you've maybe taken away from maybe in the last year, maybe 2023, that you're probably going to incorporate this year, maybe as a professional, as a human, as a fund manager? Anything that you want to share with us that you think you want to impart on us?
Yeah. So if I could go back in time, I would
Mm-hmm.
look to get um, coaching earlier,
Mm-hmm.
and the skills and the things that have made you successful early on are not going to be the skills that are going to continue on. And so really developing your EQ and awareness, even just to be able to deal and manage those types of personalities that are
Mm-hmm.
difficult to deal with, that takes work, that takes effort, that takes a lot of
Mm-hmm.
self reflection and introspection to be able to do that. And looking in yourself in the mirror is one of the hardest things to do. And I wish I would have started that earlier. If I could go back
Mm-hmm.
in time, if I could change one
Yeah.
thing, that's the kind of the coaching and the education and the almost like therapy
Mm-hmm.
for, and training for. And so that's what I would do earlier and encourage folks
Mm-hmm.
to get that and develop that early.
I saw something really interesting in my feed about like how to think about sales. So I want to share that because I thought it was just quite interesting. But with all the founders that you've supported, what's some advice on the sales side that you've given them, or maybe they've shared as learnings in terms of like, obviously converting people to paying customers? And then I wanted to share something that was pretty interesting too. But any like just nuggets of wisdom on just sales as a whole? And look, I mean, building a firm, convincing people to come onto your journey, that's also obviously a sale. Everything is a sale, right? Like getting that first job, closing capital. It's all sales. So any just lessons on that front?
Two thoughts
Mm-hmm.
and lessons, and this is what I share with the founders when we get involved early on. You can starve to death by whale hunting,
Mm-hmm.
and it's okay to eat early on and then eat well with minnows. I'm
Yeah.
exaggerating to illustrate a point, but
Mm-hmm.
that's everyone's always interested. These customers, they're always interested. They want to learn more. But you will end up starving and dying if you don't start to prove it out, get it going. Even if it's
Yeah.
not ideal, you just got
Mm-hmm.
to get going.
Yeah.
So don't die or don't starve by whale hunting.
Mm-hmm.
And then the second is really when founders are pitching and they're selling, spend the time to know exactly what the maximum you can get out of a meeting.
Mm-hmm.
It may be the next meeting. No one's bringing the duffel bag full of capital and to do the contract at that meeting.
Yeah.
So the knowing when to stop selling.
Mm-hmm.
Once you've gotten the most that you're going to get out of a meeting, politely end the meeting, excuse
Mm-hmm.
yourself, and just end it. Because
Yeah.
I have a mentor, he says, don't buy it back.
Yeah.
Once they've bought, if you keep selling, all you can do is buy it back.
Yeah.
Don't buy it back.
Sure.
And
Mm-hmm.
that takes discipline because as
Yeah.
a founders, we're passionate. I want to keep
Mm-hmm.
talking. So
Oh
I can
yeah.
tell, right? And so and knowing when to stop.
Yeah. I think sometimes like if somebody's already bought, and then you go in and give them testimonials and give them all this additional proof, then they may get suspicious. They're like, well, why is he selling? Well, why is he selling to me too much? So I get your point. And I think also, I mean, it's maybe break down the meetings into layers of information. So, you don't need to go into the first meeting, with the full data room, but just kind of the first meeting is kind of like, this is the problem we're solving. Here's our customers. Here's a few people that we've helped. And I think that is also just stuff that you learn with time. I mean, so this is what I heard, right? And I thought this was really inspiring. So actually thinking of sales like you're a doctor. So when you're a doctor, you're listening to your customer. They have certain symptoms, right? So maybe
Right.
they're a large hospital and they're having all these issues with codes for certain, healthcare procedures. So, they're listing all these symptoms, and you might not immediately go into the sale. And this is timely because you're a healthcare investor, but like, the doctor methodology is, hey, you know what, like, okay, interesting. Tell me more about your symptoms. What are you feeling? And usually when you go to a doctor, they ask you a bunch of questions about your lifestyle, your diet. So, they're listing all the symptoms of all the problems. And then I think what is next is kind of the prescription methodology. Like, okay, well, you could be having or suffering from this problem where you don't have the technology to be able to understand the codes of these procedures and you're not doing it effectively. So that would be level two, which is like, so listen to the symptoms. Level two is maybe diagnose. And then I think number three is prescribe and say, well, I think based on the diagnosis of these gaps that you have, I prescribe this. And I think if you can also spin with customer examples of people that you've helped with that same diagnosis with the same prescription and they became successful, that could be a great demonstration of like, them picturing their success potentially with your solution. But anyways, not to derail the discussion, I just thought it was kind of an interesting framework, timely relevant to your healthcare thesis. But and I don't know if you ever heard that before, but it was kind of helpful for me to kind of simplify things. So
Yeah. When I hear you describe it in that way,
mhm.
I've had to get to a similar place the hard way.
Yeah.
So now when I have meetings and initial meetings with potential LPs,
Hmm.
I I do that credentialing up early,
Yeah.
early in the conversation. Well, what's your asset allocation looking like?
Yeah.
Is healthcare a part of it? Is venture a part of it? How do you
Hmm.
distinguish venture from growth?
Hmm.
Um, what did you how much did you put to work last year? How much are you looking to put to work this year? How much is new? How much is
Hmm.
re-up?
Yeah.
I'm peppering them with a lot of questions.
Hmm.
What was the last manager that you that you backed?
Yeah.
How do you get your conviction?
Hmm.
And so basically the same things that they're asking me
Yeah.
and going to ask me, I ask them up front.
Yeah.
And this way I know this could be a long conversation. This
Hmm.
could be a short conversation. And that's
Yeah.
okay. I want to be respectful of their time. And I
Yeah.
also need to respect and guard my time,
Hmm.
because if it's not them, that's fine. And I've got a business to run the same way they do.
Hmm.
And I've got a and time is not my friend. And so I've got to, if it's not them, fine. And then the other thing I ask them is, well, how can I be helpful? Because you asked early on about community. So maybe
Yeah.
we're only doing specifically fintech bank facing solutions, or we're only doing emerging markets in Africa, or
Hmm.
the BRIC countries, something like that. Great. I know managers then, and I'd love to make an introduction. So if it's not me, fine, but I
Hmm.
want to get you to where you need to get to, and
Yeah.
get the allocation to the folks that need it and that you want to be in connection with. And so
Hmm.
I'm not offended if people say no, or not right now, or what have
Hmm.
you. But I was early on. I was like, this is my baby. This is my
Yeah.
life
Yeah.
work. It's hard. It's hard not to
Yeah.
be offended by that. But
Yeah.
I've had to learn the hard way to not be
Yeah, and
offended.
it's important too to disqualify early on, right? So sometimes, they say, "Hey, you got to qualify." Sometimes it's better to disqualify. Say, "Okay, cool. Like you only do fintech, great. It's good that you disqualify them early on instead of trying to the saying is trying to get a vegan to eat a steak, right? So I mean, if they only do fintech, it's a tough uphill battle to say, look, you know what? Why don't you try healthcare? So I think so I think disqualifying is definitely helpful. But anyways, look, I know we're up at time, and Jason, thanks for all of the wisdom. You spent an entire hour just sharing your story. So excited for the friendship, and hope that we get together more often in New York. And
Yeah,
again, really appreciate getting to know you on a deeper level and learn about your practice and career.
for sure, for sure. How can I be helpful?
I think just to me, look, the friendship is great, and I think to the community, just sharing anything that could be valuable to them, and I'll share all the artifacts that you have on your website. But yeah, I mean, I think just being yourself and continuing to do the great work you're doing is more than enough.
No, I appreciate that. Thank you.
Yeah.
We'll be coming out of this stealthy kind of mode early this year. We're
Hmm.
going to be having our first closing, starting to invest, and then being more kind of present. And
Hmm.
we've been intentionally quiet as we build, and
Hmm.
we're going to start to emerge from that. So we're looking
Great.
forward to that.
Exciting. Well, thank you for everything, and we'll catch up soon.
Thanks so much. All right.
All
Be
right.
well.
Take care.
Bye.
Bye.